Joey, Debbie, good afternoon. It's James Maher over at ABC Advisors. I'm excited that you've chosen to work with us. I'm kind of surprised. Not very often I get 46-year-olds in my office. My average client age is 72. Certainly it wasn't always that way, but when I see a couple as young and successful as yourself, it's very exciting, right? Because you've got a lot of time left. Certainly you've got a lot of goals. Right, and that's why we're here, is to plan for, prioritize, and make sure we're working towards the right end. A lot of times people do this the opposite way, where they get to the end and then they want to have goals, right? I see this all the time with Roth conversion strategies, that maybe 2 years before RMDs, or required minimum distributions, start, clients want to think about Roth conversions to lower their tax liability on RMDs. And of course, the answer at that point in time is it's too late. That strategy is really much more effective over a 10-year period or longer, right? And of course, we're going to talk about Roth accounts for you. Spoiler alert, you're just real close to being at the threshold where you make too much money to fund that. There's backdoor Roth, there's some ways around it. But, I'm going to go over this plan at a high level, and interrupt me if you have questions. And if not, I'll talk for about 15-20 minutes. And then at the end of that, I'll turn it over to you for questions. So, without further ado, I want to thank you for your business and jump right in. When you look at this, we'll go over it together. I've got a hard copy. Certainly that is the way I like to do things, to write. I'm a little old school there. So if you're using a digital copy, you may hear me turn pages, and that's just because I'm physically holding your plan, right? So, initially we've got a cover letter that tells you a little bit about me and the firm. It's my 9th year in the industry. I've been doing this for a little while. This is my 4th firm now. Spent a little bit of time at Jones, spent my first 5 years there, enjoyed it quite a bit. Went over to Maher-TAMU for a little while, private practice there. We had 4 advisors and 8 support staff. And went over to Fisher more recently, was managing about $300 million for them, over about 195 clients. And now I'm with ABC Advisors. And so I'm excited to be back here in Fort Worth and building a practice. Certainly I know you guys are in College Station. I'm down there quite frequently. I like to meet with all my clients quarterly and in person once a year. So we're going to meet in person at least once a year. Just because we're meeting quarterly doesn't mean that we can't talk more than that as things arise, right? These plans, you've heard of first in, first out, or last in, last out. There's a software thing, garbage in, garbage out, right? The plan is only as good as the data we put into it. So as things change, let me know, we'll update it. But I'm excited to get to work with you. Next, you're going to see the engagement letter. And this is going to go over, services we'll provide. Essentially, we do it all. We are fiduciaries and full discretionary, which means we pick the investments, we place the trades. So one of the things that is going to be a little different is you're not going to see investment recommendations in here, because it's kind of like Colonel Sanders. If you want to know the 23 herbs and spices, you got to buy a franchise. And when I deliver, initial recommendations, we don't put investment recommendations in there, because someone could just take it and say, oh, well, thank you for the great investment advice, and then not hire us, right? So, we're going to look at planning, all areas of planning, essentially cash flows, tax planning, risk planning, retirement planning, estate planning, and investment advisory services. Again, we are full discretionary. Which means clients don't tell us what to buy, right? So if you want to be really heavy-handed in trading, I always encourage clients to have a play account, maybe carve off 50 grand. And, if you want to buy PA stocks or GameStop or Tesla or whatever, there's a reason that we buy the stocks we buy. And, if clients are trying to manage too much, it really goes against the core strategy. So when you look about how are you going to pay us, right? So clients below $1 million, we charge 1%. And above $1 million, we charge 0.75 or 75 basis points. And really we don't negotiate or wiggle there, right? Part of being a fiduciary is we treat everyone the same. We're acting in everyone's best interest. So, the fees are there. Certainly, I feel like we earn them. I've worked places where I charge more. Most recently, I was charging 1.25 below $1 million, 1.125 above $1 million, and people didn't get a another fee break until above 5 million. So, and that's where it went down to 1%. So, when it comes to fees, I always like to say that if you want a lower fee, let's add more money, right? So, if you have questions, what'll happen is we'll have this conversation and then you'll forget we had it. What am I paying again? Believe in full transparency and fees. So give me a call. I'm happy to provide you with an invoice and a detailed fee assessment. When we look at, we like to use a lot of exchange traded funds, right? Believe in passive strategy here. How do I get paid? I've got a base pay, and then I get about 25% of all the fees that my clients are charged. So certainly it is in my best interest to grow your accounts. It's in the firm's best interest. It's in everyone's best interest. We feel like our pricing structure puts us on the same side of the table as you. When we look at conflicts of interest, when we have issues like that, first of all, I've got to disclose them. The firm has to disclose them. So we'll let you know. The same thing if there's any disciplinary actions. Obviously, I don't have any disclosures, but if we were to file bankruptcy or something like that, we would of course let you know. We're going to outline your responsibilities, my responsibilities in this document, and then we're all going to sign this, right? That way when we get 2, 3, 4 years down the road and you've got questions or maybe even a concern, we can refer back to these documents that outline the scope of how we're going to practice together. Then of course we have a disclaimer here. I'm not a CPA. I'm not an attorney. I got my second master's at Texas A&M's law school, and I had to work with a bunch of attorneys because the classes are about half advisors, half attorneys. I don't have any interest in giving legal advice, nor am I legally allowed to. Same thing with tax advice, right? We're going to talk about estate planning. We're going to talk about tax planning, but I'm not a CPA, and I can't execute those documents for you, nor can I draft legal documents. We've got folks that we've worked with. Fantastic if you don't already have someone that you work with. Same thing with our insurance partners. So I just want to throw that out there because a lot of times we're going to talk about things, and what I like to do, I've always told clients, in a perfect world, your financial advisor talks with your CPA, talks to your estate planning attorney, happy to get on the phone with them. A lot of times when I'm looking at retirement distribution strategies, I'll call the CPA and say, hey, look, here's what I'm thinking about doing. What do you think? Because they're going to understand your tax situation in much more depth than I will. I always like to say that advisors know enough about taxes to get in trouble. So, small disclaimer. When you look at the introduction, it is what it is. We've sat down before, we've talked, a little bit about me. If you want to know more, please ask me. Just had a second child, and so if a baby is in the background, certainly that's our Madison, our newest addition, who's about 8 weeks now. So we got your client profile, your kiddos, his and hers, and we've got goals and objectives. Certainly, I know that healthcare needs in retirement and having enough money in retirement are your biggest goals, right? And it should be. I find the client's biggest fear today is, am I going to outlive my money as people live longer, right? And I'll just tell you right out of the gate, looking at this, you're good to go for retirement and healthcare. There's going to be some stuff when we look at legacy planning where maybe we're going to use some creative solutions. Maybe we dial back some spending on some other things. But the big elephant in the room of can I retire? Right now, you're 100% on track to retire. Now, I want to recommend that you save a little bit more because you've got a tremendous amount of goals, and that's fine, right? That's what makes life fun. But you're on track to retire. Now, when we look at college for the 3 kiddos, I want to recommend a plan. It's about a third, and I'll tell you about that in a little bit. Certainly, we're looking at Reagan's wedding. Maybe we don't have the 7-day Indian wedding where we entertain folks 24 hours for 7 days. Cars and trucks, I know you guys want to get new vehicles about every 5 years starting in retirement. Might dial that back a little bit. Travel is awesome, right? And when you're retired, you're going to have 8 hours a day extra to be a consumer, 8 hours extra to travel. And what I see there is that, clients expect to spend less. So when I do planning, I always like to plan to spend about the same as you're spending now, because you're doing your bucket list items, you're doing those things that are fun that you've waited your whole life for. Now, home improvement, I know you were thinking about paying the mortgage off and putting about 60 grand into renovations. And we'll talk about that here in a bit. Celebrating the anniversaries, providing care for Debbie's mom, and then leaving some money to the church and leaving a legacy for all 3 kids. That's where we're starting with, call it $700,000. And, we're trying to leave over $1 million behind. We're trying to spend over $1 million. We're trying to put kids through college, which is about $1 million. We have a lot of goals here, and we can only stretch a dollar so far. So I actually have kind of a creative insurance solution for that, which we'll talk about here in a sec. When you move on through this plan, we've got some assumptions here. So if you're wondering, like, what are my economic assumptions, what are my investment assumptions, retirement planning, education, so on and so forth, that's their kind of boring stuff. It's how the sausage is made. But the executive summary here is really going to be your sort of go-to game plan. It's the short hit list of, like, what do we want to accomplish. I know you're thinking about paying off the mortgage on retirement, new vehicles every 5 years. I think we got to get the idle cash invested immediately. We'll talk a little bit about behavioral counseling, which is going to be a huge part of what I do, education and getting you guys through tough markets, so we don't go to cash, right? You guys went to cash April of 2020, and the math I did on that, even in the bear market we're in now with the losses we have this year, the opportunity cost there sitting on the sidelines was about 65%, which is huge, right? That we're having a different conversation if your portfolio is 65% higher than where it is today. But you're not the only ones. I had a few clients go to cash. It is it's humans. We have hurting behaviors. We're very emotional. People want to buy the top and sell the bottom. And Vanguard wrote a white paper on it called Advisor Alpha, where essentially if you can pay someone 1 or 1.5% to keep you from making these very common mistakes, that it's well worth it, right? Because it's going to increase your returns. But we'll look at risk planning, college funding, estate planning. I know you guys want to think about Roths. Unfortunately, you're like right at the threshold of the top of the phase out. So that might not be doable, especially as your income increases. Debbie, you've got to open up a SEP and fund it basically immediately, right? We really need you to start saving for retirement. Whether we look at a SEP or a simple, that's going to be, are you going to pay yourself more than 60 or less than 60 grand? Right now, that answer to the question is yes. And of course, tax strategies, order of liquidations, estate documents. I'll jump the shark here. All your estate documents need to be redone. We're going to send you over to a buddy of mine, Marshall Bridges, who's going to take care of all that pretty cheap. But they've got your deceased spouse on there, Joey and Debbie. You've got your ex-husband on there, so they need to be reworked. When we look at cash and debt management, you guys are doing great. You don't have any personal debt. You don't see that very often. You got to continue that. Right. Now the student loans, I know Debbie, you were thinking about paying those off. I don't think at this point in time that you throw any lump sum at it. I think you continue with the plan that you had agreed upon. Same thing with the home renovations. I don't think we do that. I mean, Joey, I know you're thinking, I want to drop 120 grand, pay off the mortgage, and that feels good, right? It sounds good. And then put another 60 grand. You're looking at putting $180,000 into a house and taking a huge chunk of your growth engine out of your portfolio day one of retirement. So I absolutely don't recommend that. Your mortgage is pretty cheap as far as interest rates go. I know you were thinking about getting a new mortgage or refinancing. I think Fed funds rate was at 2.75 after the most recent Fed hikes. So rates are going up, right? They've come down for 40 years, so they really have nowhere to go but up over the next 40 years. So I think you keep what you got. We can shop it around. And if you find something better, great. I mean, we're going to factor in the cost of what it costs to refinance the house, but I don't think at this point in time that's necessarily something that we want to spend a whole lot of energy on. Again, get the cash invested immediately. We're recommending about 55% stock, 45% bonds. We'll do all the investment stuff. Honestly, you're young enough. I think if it were me, I would have a much higher equity exposure, almost 100%, especially given the goals you guys want to fund. And we could talk more about that in our next meeting, but right now the recommendation is 55% stocks, 45% bonds. I do think that you take 6 months worth of expenses, the cash you have now, leave it in cash. That's your emergency fund. 529 plans, education planning. We're gonna set up a 529 for each kid. We're gonna put about $1,200 a month into that for each kid. Risk management, again, home and auto look pretty good to me. You want to get 3 quotes and try to find something cheaper, great. Don't forget about customer service. You get what you pay for. As far as insurance goes, Joey, you've got some good life insurance. I think you guys need an extra $1.5 million. And this is where it's kind of creative solution to solving 3 problems with one stone. So long-term care really has gone the way of the dinosaur in this industry. And what people are doing is, instead of writing long-term care, which got more and more expensive every year, is they're writing a life insurance policy with long-term care riders, disability rider. You can get different riders for all these things that you want. And instead of use or lose, like long-term care, it's use or use, because if you get sick, you use it, and if you don't, if you get sick, you access the death benefit early, and if you die, you give it to your kids. So I think you get $1.5 million, you leave $500,000 to the church, $300,000 to each kid, and then that gets you guys over $2 million worth of life insurance, and it checks a bunch of boxes. Certainly, I recommend you guys get a $1 million umbrella policy, which I recommend for pretty much every client I have. Got to get the cash moving immediately into investments. You got to start max funding 401ks, Roths, IRAs, however we do it. We got to max fund. We got to save more. Again, I think we do that by reducing some of our discretional spending. Again, I don't think you pay the house off. I don't think we renovate the house. We set aside 6 months worth of expenses in the current cash. We're going to open up 3 529s and fund them for all the kids. Again, one of the big red flags that I saw when I was reviewing all your stuff is the estate planning. It's got everyone else's information on there as far as ex-wives, ex-husbands, and that really needs to be taken care of. From a tax planning, when we implement this strategy, because you went to cash, you already paid all the long-term capital gains taxes in 2021. So there's not really going to be any tax hit for you there, right? When you think about taxable accounts, you're not going to be taxed on that until you sell, and you've already sold. So putting cash to work, not going to be a huge problem tax-wise. When we look at order of liquidations and retirement, we're gonna sell off taxable money first. Let the tax-deferred money grow as long as possible. Tax-deferred, that's going to be sold off next. Lastly, you're going to hit Roth and tax-free. I think when we hit about 55, we look at doing some Roth conversions, depending on what's going on in the market and your tax bracket, obviously. But that is the high-level overview in a nutshell. So, I will turn it over to you guys. You can see on our estate planning how we've got the chart there of who goes to what. And we've got some notes there, but the main things, the biggest takeaway here is you're going to be fine for retirement. I want you to save more. I want you to spend less. We might work a little bit longer, and we can talk about that in our next meeting. Some of the goals, some of the wishes, right? We're going to do that through life insurance planning, with life insurance with a long-term care rider, just increase our total death benefit. That way it's there for whatever we need it for, whether it's disability, long-term care, leave it to a kid. But I'm really excited to get to work with you. I want to thank you again for choosing ABC. So, again, what questions do you guys have?